Dividend growth investing. What is it? What's a dividend growth stock? Is it a good strategy? A lot of people on YouTube think it's a great strategy and the best thing that you could do with your money. But let's take a look at some research. Let's look at what the professionals who are much smarter than me have to say about it, and if it's something that maybe you should do with your money. All right, so before we get started, give me that thumbs up. Make sure you hit subscribe and turn on notifications so you'll be notified every time I release a new video. Thanks. All right, so we got to start with the basics and go over exactly what a dividend is. Most of you probably already know what a dividend is, but just real quick, a dividend is a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserves. So what does that mean? Well, a company has one goal, and that is to make money. When it makes money, which is known as earnings, it can do one of two things with those earnings. It can put it back into the company or pay its investors. Some companies don't give dividends, they're just taking all of their money and putting it back into the business to grow. That's a growth company. And then there's other companies, usually more mature blue chip companies, will pay out their investors with dividends. Typically, you'll see companies pay out anywhere between 30 and 70% of its earnings. Usually want to go below that 70%. Their dividend yield, which is pretty much an equation of how much they're giving compared to how much their stock is worth. You could see anywhere between maybe 1% and 4%. So if you have a stock that's worth $100 and they have a 4% dividend yield, they're giving you $4 throughout the year. Now I could keep going on about dividends, but we'll save that for another video. Let's get right into exactly what a dividend growth stock is. So a dividend growth stock is essentially a company that is still growing, there's still momentum, they could still reinvest into the business, but they're also paying you out. And that dividend is growing every single year. So what's a good example of a dividend growth stock? Let's look at Target. So if we look at Target, if we go to the dividend section on Seeking Alpha, you can see the dividend yield is 2.3%. So the stock is $114 and it's paying you 2.3% of that $114 in dividends. That annual payout comes to $2.64. That payout ratio, this is where the important stuff comes into play, is 51%. And now this is where dividend growth investors get really excited with the growth rate. So we could see here, Target's dividend growth rate over the past 5 years is 6.47%. So why is that important? That's because their dividend has been growing for its investors by over 6% each year. That's above the rate of inflation. That's why dividend growth stocks are so attractive to a lot of investors. Not only are you getting a company that's going up in price every year from capital appreciation, but then you also get a dividend that is growing at the same time. But we want to look at the history of its dividends growth. That's something that's very important. And looking at this chart, you can see every single year its dividend is in fact growing. You could even see back in 2008 and 9, it didn't even skip a beat. Just because we're having the financial crisis, they were still paying out their investors with dividends. And that's really good to know for what's going on right now in 2020. A lot of businesses are cutting dividends or lowering their dividends. Okay, so we were able to find a good dividend stock, or what I at least deem to be a good dividend stock. But what about stock that might not be so good, and what about really bad dividend stock? How can you spot the bad ones? Well, first, let's look at Chase. I still think Chase is a good stock overall. But if you are a dividend investor, you might not want to jump into it, because if we look at its history, 2009 and 2010, it took a massive hit. And it took several years before it could be back on pace with what it was paying. Now, one thing that's really not talked about a lot on YouTube when you're looking for dividend growth stocks, because what I've noticed is a lot of YouTubers will just buy up 100 stocks, so if 10 of them fail, it doesn't matter, they have another 90. But if you're having a more concentrated portfolio, or you really want to pick out just the winners and go the extra mile and do more research, here's something that is critical for you to look at when you want to buy into a dividend stock, or if you want to take on a dividend growth investing strategy. Now, a company that comes to mind that is a bad investment and a bad dividend stock is Boeing. We all probably know why Boeing's not a good stock anymore, because it is an airline company and it's being massively affected by this pandemic. Not only has the price plummeted, but it has cut its dividends. It no longer pays out dividends. We could see its dividend history. It was paying out dividends, and if we scroll back, it was constantly paying out dividends and growing every single year, even through the financial crisis and the dot-com bubble. But here's why I would have never bought it as part of a dividend growth investing strategy if, say, we were to rewind a year ago before the pandemic happened. If we look at Boeing's financials, and this I think is something really important that you have to do when you're looking for dividend growth stocks, when we look at the earnings before interest, tax, depreciation, and amortization, we can see that its earnings last year in 2019 were significantly less than 2013. That is a big problem. There's something wrong there, and you need to do some more digging. And the one thing you need to look at is, okay, its earnings has dropped drastically, so what does its long-term debt look like? Because if it's not making money, how much debt is it carrying, and can it actually afford to pay that debt? In 2019, it jumped over 100%. 2018 was $8 billion. 2019 was $18 billion. That is a major red flag. That's something you wouldn't want to invest in, just in general. You wouldn't want to invest in the stock, whether you're looking for growth or for a dividend, because that means something is seriously wrong with the company, and who knows if it's going to be able to recover from this. And as you can see now, it has $32 billion worth of long-term debt, and its earnings, for obvious reasons, is in the negative. So that's why they cut their dividends. That's why even back in 2019, I wouldn't put my money into this stock for a dividend growth investing strategy. Now that we talked about the good, the bad, and the ugly when it comes to dividend growth investing and exactly what companies you should look out for, is the strategy as a whole worth it? Let's look at what this one guy on Seeking Alpha wrote about, an article comparing a dividend growth investing strategy and then the S&P 500, if you were to just put all your money into the S&P 500. And as you can see, this study was over the period of 9 years, back in 2011 all the way to 2020, and one portfolio has a bunch of dividend paying ETFs, dividend growth ETFs, and if we were to pair it up to the Vanguard 500 index, both an initial investment of $10,000, we could see that the S&P 500 outperformed it, and its standard deviation was a little bit higher, its best year was a little bit higher, its worst year was actually lower, and its max drawdown was lower. You'll hear a lot of dividend investors say, oh well, dividend stocks are great companies to invest in because it has downside protection. Right here, this proves that it really doesn't. And yes, this is if you were to reinvest your dividends into the companies. And you can see that the S&P 500 outperformed. And again, I'm not saying that forget about dividend growth investing. It still is a great strategy, and the reason why is because it can keep your emotions in check. Even though it may not make as much of a return as something else, and this is only a small period of time, I'm sure you could find tons of examples. Oh, well, if you go back to 2006 and try this, then dividend stocks beat it. Well, there's really no science to it. There's no exact evidence or exact proof of which strategy is the best, because if we knew that, that's what everyone would do. But I think dividend growth investing is a great strategy because it will keep your emotions in check. You know that, hey, I'm holding on to this company even if the stock goes down during a financial crisis or during a bear market, you still want to hold on to it because it's giving you dividends. And you're buying better, bigger, stronger companies. You're buying into those blue chip companies that are safer, so you don't fall into the trap of the fear of the market going down and you selling. That's the biggest problem with retail traders. That's what we're considered, retail traders, the amateurs, right? We're selling all of our stocks while it's going down, and then we'll buy up at the top, and we're really making little to no money. But dividend growth investors have an edge on their emotions because they know, hey, my stock may be down, but it's still paying me those dividends. I don't want to get rid of that stock because I want those dividends. And then when we go through a full market cycle and the market's back up, now the dividend investors think that they're geniuses because they were able to keep their emotions in check. So that's my opinion with dividends, but there are other strategies out there. It's not the biggest and best strategy, but let me know your thoughts. What strategies do you follow? Do you like dividend growth investing? Do you not? What other videos do you want to see from me? And as always, give me that thumbs up, hit subscribe, help boost the YouTube algorithm for my channel. I'll see you in the next one.